Hi, I'm Max Keiser. This is the Keiser Report. Hey, you there in London, I'll be at the King's Head in Borough at 8 p.m. for my Max Rage live show. Yeah, I'm still on tour, taking it to the bankers. Stacy Herbert, what's happening with the bankers and all their fraud?
Well, Max, is this your presidential tour? Because I see from this little video here, somebody in Pennsylvania is driving around with a nice, what, is that an Eldorado? And it says Keiser-Celente 2012.
Yeah, well, Celente was going to fund our campaign until he lost it all at MF Global. What's up with that, Gerald? Yeah, no, I think that's a Fleetwood. Cadillac Fleetwood.
Well, speaking of MF Global, I have quite a few stories on that. First, we're going to turn to a video here, and this is Bill Fleckenstein, and he's being interviewed on CNBC, and he's asked by the presenter whether or not he thinks he'll see his money back.
I do think there's some possibility that the money will show up because it occurs to me that if, in fact, seg funds were misappropriated, that would have had to be several people involved with that, and I'm surprised that if that were the case, someone hasn't been charged with a crime yet. And since that hasn't occurred, it might just be the sheer volume of people heading for the exits combined with bad systems could have resulted in this missing $600 million.
Oh, my God. Well, either Bill Fleckenstein is a bimbo, or he's desperately trying to talk his way into getting his money back, or both. This is kind of interesting that professionals who've written books, you know, Bill's written a book about the corruption in the banking sector, and when it happens to them, whether it's Bill Fleckenstein or Gerald Celente, of course, is a little bit more savvy in terms of the fact that he got unmercifully Penn-stated by the banks. Bill Fleckenstein seems still in denial. He's like a wife-beating victim. Oh, I got my money stolen. Please do it again.
Well, you must have heard this many times when you lost money for clients as a banker.
They blame themselves. That's what's fantastic about having customers when I was working on Wall Street. You lose their money and they blame themselves. That's fantastic. You just keep stealing their money and they keep crying about it. Oh, I'm so bad, I need, help me, relieve me of my money and the guilt.
So here's Bill Fleckenstein praying, hoping, believing that all the good faith in the world that the money will be found. Well, let's turn to another clip where Bart Chilton, one of the executives at the CFTC, which is regulating this market, well, he's asked the same thing. Where is the money?
Good question. I've been doing the Jerry Maguire, show us the money, for a couple of weeks here. We've had people there, and it's not where it should be, but it looks suspicious as heck to me. It's either nefarious or illegal, in my personal opinion. But that's why we have an investigation. The money should be there, Andrew. It's not. That money should be sacrosanct, and it's really troubling.
Oh, Bart Chilton. His name keeps coming up. Remember a few months back, he was involved in the Cantor Exchange, HSX, box office futures scandal. We got inside information about how he was working with MPAA and all the skullduggery got done behind the scenes on that one. Now he's claiming ignorance, like, oh, we don't know where the money went. Of course, they went into the account, as Celente has said so eloquently. They stole my freaking money. They're just steal money now, and pretty soon they'll steal money accompanied by a knock on the head and thrown into prison. That's what happens when you let kleptocrats run the system, whether it's in Greece, Ireland, America, the UK. This is their methodology.
Well, he refers to Rule 1.25, and this is a regulation brought in. I know you're...
What? Oh, yeah, rule. Yeah, there are a lot of rules that they obey down there at the CFTC. Oh, yeah.
So, from 2005, bankers, the brokers trading on this exchange here, were able to use internal repos to basically buy any debt in the world. Here he explains it a little bit.
And one of the things that we did was we allowed these internal repos back in 2005.
Internal repo, just to explain to people, this is something where you can internally commingle some of the accounts for the part of the day? Is that
well, you're not supposed to commingle it, Becky. What you do is you take the segregated customer money, which is supposed to be sacrosanct, job number one for us. They take that money and they use it for something that is supposed to be a safe investment, like maybe a AAA sovereign debt or a U.S. Treasury. But it's a temporary thing. You agree to buy it back. That's the internal repo.
Let me explain something about the so-called rules in Rule 1.2.5. All of the banks on Wall Street doing what they're doing today, the money center banks, the too big to fail banks, if they were being governed by the laws that were in place 15 years ago, they would all be in jail today. However, because of the money they've made stealing, buying congressmen, buying senators, buying the Supreme Court, buying the judicial system, buying the political process, those laws don't exist anymore, or they change the law. Here's Rule 1.2.5. What year, 2004?
Regulation 1.25, which was relaxed in 2000 and then further relaxed in 2004, 2005.
Yeah, well, this is what is an example of there's a rule in place, a law, to keep people from stealing. Like you see a gate in front of Winston's Jewelry down here on Plaza Athénée in Paris. That gate, that armored guard, the bulletproof glass is there for a reason. Because otherwise people would just take all the jewels. So there's rules. So here you have in 2000 and 2004, 2005, every single year, the banksters, the criminals, the people who in 1793 in Paris got their heads cut off because of damn aristocratic, kleptocratic maniacs who steal money. Those people decided to rewrite the laws because they want to steal the money with impunity. And the regulators said, give us a bribe.
Well, Max, you mentioned Winston Jewelers, and I do believe it was actually robbed a few years ago by a man dressed as a woman.
Don't look at me. Don't look at me.
No, but
I would never be caught in public with high heels of that color. I'm a Chanel man.
So let's turn to this woman in this next story, Lori Ferber. She's chief counsel at MF Global. And prior to that, she was chief counsel at Goldman Sachs for 20 years. Okay, now
killing me. You're killing me with this.
She's at the heart of this, the relaxation of Regulation 1.25, okay? So tiny rule change at the heart of MF Global failure. From December 2000, the CFTC, that's when they first agreed to amend Regulation 1.25 to permit basically riskier investments that could make more money for Wall Street. Remember, they didn't have to share any of those profits with their clients, but they were taking their clients, the customer funds, the segregated funds, and betting it overnight, but they had to replace it in the morning. So then in February 2004 and 2005, Regulation 1.25 was further amended and refined to the liking of Ferber and the banks. In the end, the door was opened for firms such as MF Global to do internal repos of customers' deposits and invest the funds in the general obligation of sovereign nations.
Okay, well, here's the thinking that went on here. You see, because sovereign debt, AAA rated or AA rated sovereign debt, is considered to be creditworthy. But, of course, the CFTC, SEC, FSA, CFO, SFO, PPP, all these regulatory agencies that add up to a big bowl of alphabet soup of nothing, they didn't bother to take a look at the fact that concurrently with the sovereign debt being used as collateral to perpetrate fraud, there's collateralized, credit default swaps and other derivatives that are created to do an end run around the margin requirement, the minimum capital requirement, the sovereign debt requirement as stipulated by Basel, Basel I, Basel II, Basel III. See, they went around that because they've got 10, 20, 30 times more credit default swaps than there is sovereign debt. How come Greece's debt keeps getting downgraded? How come Ireland keeps finding itself in the pooper? How come the entire Eurozone is collapsing? Because every time they announce a bailout of a $1 trillion or $5 trillion, Wall Street and the crooked banks just issue 50 trillion more credit default swaps. Doesn't matter if you put up 100 cents on the dollar in a AAA rated sovereign credit. If I've got 40 trillion in CDS to sell naked into the market and drive your sovereign debt down, I'm going to win, and I'm doing the Penn State on you.
The fact is here that they were leveraged 50 to 1. So all they needed was a decline of 2% overnight. And this was on European debt, which was moving at 3, 4, 5, 6, 7, 8, 9, 10% overnight. So, of course, there was a run on their big thing.
Right, but that run, that move and that debt is not a market behavior. It's manufactured through market manipulation. Let's be clear about that. That's not a normal market. There's no normal price discovery happening in this market. The prices are determined ahead of time, then Goldman Sachs manipulates the markets or JP Morgan manipulates the markets to achieve the price that they predetermined. That's where we're at now. Free market capitalism is dead.
Well, I'm surprised you didn't pick up on how I set you up there for this Lori Ferber in relation to the jeweler theft at Winston's, because I assumed that she could be Goldman Sachs's own Lloyd Blankfein, dressed as the general counsel, going into these meetings with the CFTC, arguing.
Are you suggesting that Lloyd Blankfein is a cross-dresser who dressed up like this regulator for the CFTC and goes into meetings and lobbies on behalf of his firm, playing the woman card? He's trying to seduce. What is, oh my God.
Now, this
I just
is
had a
used
very
by-
strange thought of Lloyd
You're turned
Blankfein.
on? You're turned
No, but I mean, how far did he go? How far did Lloyd go to get these rules changed? Oh, Lloyd, you're a bad boy.
Well, I'm finally on MF Global.
Ugh.
PigFest 2011. Bank of America Merrill Lynch is offering to buy claims against MF Global. So Bank of America's Merrill Lynch unit is soliciting for the purchase of claims against MF Global. As you may recall, Max, Bank of America is one of the major creditors of MF Global with JP Morgan and is reported to be one of the debtors, along with JP Morgan, involved in the litigation trying to obtain superiority of their claims over customers whose money was taken, lost, stolen by parties unknown for now.
Plus, their balance sheet is owned by the Federal Reserve Bank. So when they say, oh, Bank of America, or who else? What other fakakta
It's
club?
called Bank of America Merrill Lynch.
Yeah, they're just joined into the hip with the Federal Reserve Bank, who's just going to expand their balance sheet by however many trillions it requires to make whole these unholy securities.
Yeah, but it's also, Max, the case is here that because of their power in this mafia, this syndicate, this racket, they're able to put these segregated account holders in a distressed position by being more powerful to be able to step in front of them in this chain of creditors standing in line at the trustees.
Yeah, well, that's true. It's another leg to the massive manipulation scam of putting these people into a stress position similar to what they do in Guantanamo Bay.
And finally on this story, Jesse's Cafe American says, I have nothing against vulture funds per se, although what I hear a few of them have done with two of the failed Icelandic banks and their former directors proves Rule 4 of zombie banking land. Always use the double tap.
The double tap refers, of course, to 2 shots to the head.
2 shots to the head, which brings me to more Giabo art sent in. Max Keiser, vampire banker hunter.
Oh, there I am, hunting the...
hot.
All right, Stacy Herbert, thanks so much for being on the Keiser Report.
Thank you, Max.
Don't go away, much more coming your way, so stay right there!
"20 years ago, the largest country in the world disintegrated. What had been one became many, and each began a journey. Where did it take them?
In the United Kingdom, RT is available in Durley House, The Landmark, 41 Hotel, the Old Waverley Hotel, Egerton House Hotel, the Milestone Hotel, Summer Lodge Country House, Holiday Inn, the Bull, the Old Government House, the Rembrandt, the Cranley, the Chesterfield, the Montague Hotel, the Royal Park, the Rubens Hotel.
Hi, I'm Max Keiser. Welcome back to the Keiser Report. Time now to go to New York City. Speak with Barry Ritholtz of Ritholtz.com. Barry is a market analyst, blogger, journalist, and author of Bailout Nation. Welcome back to the Keiser Report, Barry.
Thanks for having me, Max.
All right, Barry, first let's talk about your piece in the Washington Post. What caused the financial crisis? The big lie goes viral. Tell us about it.
Well, there's been this tendency amongst people who helped create the crisis, and rather than admit that radical deregulation and allowing bankers to set their own rules and granting special exemptions for the 5 largest banks to ignore the leverage limitations, or allowing derivatives to be completely unregulated with no reserve requirements and no counterparty disclosures, rather than say, hey, this was really a big mistake, oops. Instead, they've created this false narrative, this argument that, you know what really caused the crisis? It was the government forcing banks to lend all that money to minorities and inner-city poor people. That's what caused the crisis. The fascinating thing is the data overwhelmingly says that's not the case. We know they took leverage as soon as they were given permission from 12 to 1 to nearly 50 to 1. We know that they engaged in all sorts of speculative activity where they didn't understand the risks. Their models were just wildly optimistic. They were so busy counting profits and bonuses that they didn't pay attention to the bottom line. Look, it all comes down to some very, very simple rules. Banking is supposed to be boring. The job of a banker is to make decisions about who is creditworthy and who is not. To give you an idea of how reckless the banking industry became, not only did they create these no-doc loans, they stopped validating loan-to-value of the home. They stopped valuating credit scores. And most importantly, they stopped asking borrowers how much money they earned. And that is the single most important factor in determining if someone's going to repay a mortgage or a loan. How much do they actually earn? Can they service that debt? So when I hear this nonsensical things, banks were forced to make loans to poor people, nobody told the banks, don't check income, don't check credit rating, don't check all the usual metrics that have worked for thousands of years. It's just nonsense. And when I see people propagating the big lie like that, it makes me stop and say, what are these guys hiding? And it's pretty clear what they've been hiding. They have an intellectually bankrupt ideology, and it's causing global damage to the economy.
All right, you mentioned the leverage ratios being increased from 12 to 1, and the banks are leveraged at 50 to 1. Even the Federal Reserve Bank itself is leveraged 50 to 1. That goes back to 2004, I believe, when Greenspan lifted that cap. But you refer to that as ignoring leverage limitations. But isn't that a hard-coded law in terms of what the leverage limitations are according? Aren't there laws in place? Does it go back to the Basel?
Yes.
Okay. So they are therefore...
Well, now, it depends on who, Max, it depends on which financial institution you're talking about. If you're talking about depository banks, they have reserve rules which are implemented by the FDIC and others. If you're talking about investment banks, there's the 1975 rule that limited them to 12 to 1. The 5 biggest investment houses in the U.S. got a waiver of that. Ironically, it was called the Bear Stearns waiver. Bear Stearns, Lehman, Merrill, Morgan, and Goldman. The only ones somehow exempted from that law. Stop and think about what that means. Here's a law that applies to everybody except you 5 guys who happen to be the single biggest donors to Congress. And that, by the way, that waiver was granted by the Security and Exchange Commission. The Basel rules for depository reserves, how much they have to hold, what's fascinating about those is they've been whittled away over time, so the amount in reserve has come down fairly substantially, which allows their leverage to go up. So anything that gets in the way of profit, regardless of risk, there is a lobbying effort to try and reduce that. It was very successful with the SEC. It's been somewhat successful with the Federal Reserve and the FDIC, and that's why there's so little capital in all these banks, both in the U.S. and Europe. In fact, the underlying cause of the entire global headache that we're still dealing with is too little capital, too much leverage.
All right, so the law is that they have to have a certain amount of capital versus leverage on the books. And what happens and what we've seen is that if anyone starts to sniff around, then they do something like what Lehman Brothers did with the famous Repo 105 scam, where they simply moved debt off the balance sheet temporarily to satisfy a regulator that might be looking at them. And then when the regulator leaves the room, they put that debt back on their balance sheet. Isn't that also the case? These off-balance sheet entities are hiding huge debt.
First of all, what Lehman Brothers did with 105, that's just fraud. Let's not mince words. Let's not pussyfoot around with this. They're a bunch of criminals. Some of them should go to jail. And unfortunately, most of our prosecutorial staff are too busy chasing other nonsense. But there's just no doubt in my mind that Dick Fold and his CFO should be wearing striped suits with numbers. That is criminal. You cannot hide $100 billion or $50 billion at a time in spending and then put it back at the end of the quarter. I don't know where the SEC is. I don't know where the U.S. Attorney General is. It's laughable. That's number one. Number two, if you look at the movement that's starting to pick up a little speed in the United States, people have been moving their money away from the big banks to the small local community banks. And what we found is that these small community banks, they're much more solid. They weren't involved with derivatives. They weren't involved with subprime lending. They embrace what we call boring banking. They borrow money at 4%, they lend it at 6%, and they're out on the golf course at 4 p.m. And that sort of local community banking, that sort of credit union banking is potentially the biggest threat to the major banks. There's 6,000 or 7,000 of these banks in the United States. Some of them are 5 and 10 branches large. Some of them are 1 or 2. They're all insured by the FDIC, so your money is safe there. It hasn't been enough to affect their quarterly earnings yet, but if that were to happen, I think you would really start getting people's attention.
All right, Barry, we've been watching these banks commit massive fraud, not the community banks and the credit unions, as you were just mentioning, but the two big to fail banks, the big Wall Street banks. They're in violation of the minimum capital rules without a doubt. They're violating the law every day. We've been watching this grow over the past few years. But recently, just this past week, I think we're setting a new standard for criminality with the MF Global scandal. It seems that they're just reaching right into people's accounts and taking their money directly. Barry, talk to me. Is this a new chapter in the fraud?
Max, what do you think? It's your money? You think you're entitled to your money? That's our money. And if we decide we're going to need it to leverage up even more, the hell with you, we're taking it. MF Global is just a whole different order of magnitude. This basically, you know, when you fill out an account form, there are all sorts of things about what the bank or the investment house can do with your stock, let's say. We can hypothecate it, we can short against it, we can lend it. There's a bunch of things that could be done, and it's supposed to be governed and regulated pretty clearly. There's a pretty bright line as to what you can do and what is just out-and-out theft. At least what it appears so far at MF Global, and maybe they'll find the missing $600 million. Maybe, you know, it's in a drawer or someone made a line entry somewhere that's wrong. But from the appearances we've seen, this looks like someone just backed up the truck, wiped out the client's money, and said, the hell with them, we're stealing it. It's just beyond outrageous. And I think if anybody is going to jail in this whole past 5-year period, it has to be someone from MF Global. If they can't find this money, there's no other description for it. It's just grand theft.
All right, now J.P. Morgan and Bank of America, creditors to MF Global, are saying their claims come ahead of the customers. Is that proper?
You know, when you're involved in this sort of bankruptcy litigation, everybody says that sort of stuff. I think that there's some insurance on the accounts and there's some guarantees, but if it turns out that the creditors have a superior claim to people who are opening accounts, why the hell would I ever open an account with anyone again? Mattress sales are going to tick up because that's going to become the new banks. It's unthinkable that somehow an outside creditor is going to have a superior claim to somebody who actually had their money with a brokerage firm. In this case, it's a combination of SEC and commodities futures regulators who are supposed to be watching this. Look, the key takeaway from all of this is regulators can only do so much. If someone is intent on stealing, they're going to steal. What you have to do as a regulator or a government is make sure that when these people get caught, they get thrown in jail as a discouragement to other people. My takeaway from the crisis of 07, 08, 09 is steal whatever the hell you want and run for the hills. Nobody cares. No one's going to prosecute you. Maybe MF Global will get us to the point where someone goes to jail and that acts as a discouragement to future people. But right now, the lesson that they're going to be teaching in business schools is don't do what Lehman did. Don't just screw up a little bit. Do what Bear Stearns did. Screw up really big, and don't worry if you're a bondholder, you'll be made whole.
Yeah, I don't think a lot of people realize that when you open a brokerage account, you sign off on documents that you're bound to arbitration for any disputes. You don't get to go to a jury.
That's correct.
You don't get to go to a judge. 98% of all complaints against the industry are unresolved. Nobody ever gets their money out of the industry. And the pari passu to that, Judge Rakoff on the Citigroup case, the $285 million that Citigroup stole. Judge Rakoff says that, well, the SEC is going to have to figure this out because the federal judicial system doesn't have dominion over these criminal acts. So there is no law governing the criminal acts of these various banks, is there?
It's good to be the king. Listen, you know, when you have a congressional system that is based on eBay, when you could buy a congressman or a senator, when they get sold to the highest bidder, who gives a f*** about regulation? Who cares about any of that? You can do whatever you want.
We have about 30 seconds left. What do you think about this story that Congress is legally allowed to engage in insider trading with pre-IPO stock given to Congress people? It's not legally considered to be a bribe. Your thoughts?
It's consistent with everything else we know about the Parliament of Whores that is the U.S. Congress. They are up for bid. You know, we really need a third party to actually see if we can maximize how much we could sell them for. Place your bet, buy a congressman, get whatever regulation you want passed. That's how America works in 2011.
All right, Barry Ritholtz of Ritholtz.com. Thanks so much for being on the Keiser Report.
My pleasure, Max. Sorry to make you work with the editing.
No problem. That's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank my guest, Barry Ritholtz of Ritholtz.com. You can follow us on Twitter. You can follow us on Facebook. You can follow me, Max Keiser, on Twitter. And follow me instead of Stacy Herbert because I'm trying to stay ahead of her. And trust me, that's what you want to do. If you want to send me an email, send it to keiserreport@rttv.ru. Until next time, Max Keiser saying, bye, y'all.